Hello and welcome to the Signal or Noise Income Investing Show for 2024. And welcome to what Livewire is calling the Goldilocks era for income. I mean, just think about all the options that are available to today's income-seeking investor. Investing in a listed government bond ETF now carries a 3% plus running yield. Putting your cash in a 12-month term deposit now nets you 4.6% nationally on average. Some products can get you well over 5%. Tier 2 bank bills can now net you roughly 7 to 8%, while the yield on some top-performing fixed income funds, like the Coolabah Long Short Credit Fund, which we're using here as an example, can get you 7% plus running yield and 12 to 13% sometimes in total returns. And where do stocks sit in all this? Well, you've got the ASX 200 with its running dividend yield of about 3.9%, while a basket tracking the 50 highest yielding stocks having an average yield, or an aggregate yield I should say, of 5.8%. With all this in mind, we're going to try and answer two key questions. Why should you get out of cash if you're still in it? And if you're looking to do so, where do the smartest opportunities lie? Joining me are three people who will hopefully have some answers to that question. Michael Price is Portfolio Manager of the Ausbil Active Dividend Income Fund. Welcome, Michael.
Thank you, Hans.
Amy Patrick joining us too, Head of Income Strategies at Pendle Group. Welcome, Amy. And sitting in for a travelling Deanna Messina this month is her boss, Dr. Shane Oliver, Head of Investment Strategy and Chief Economist at AMP. Good to see you too, Shane.
Thank you, Hans.
So let's get straight on with it and talk about our first topic, something that Australians all have a love affair with, dividends. A combination of slowing earnings growth and cyclical pressures has depressed the ASX 200's dividend yield. And as you can see in this Morgan Stanley chart, the long-run average yield is usually about 4.6%, but it's currently hovering around 3.9%. And even the high dividend yield index is at about 5.8%. And again, that is also a far cry from where it used to be. So, panel, and Michael, I'm going to go to you first. Is the index's below average dividend yield a signal for concern, or is it noise? And Michael, with that, signal or noise?
Look, I think it's a signal, but I actually think it's a positive signal rather than a signal for concern. The reason the dividend yield is at its lows is not because dividends are still falling, but because prices have started to rise ahead of an increase in earnings. So what that low dividend yield is showing or suggesting is that the market thinks that dividends are going to start growing again. And that's good news for dividend investors.
Okay, well, on this subject, let's take a closer look at the chart you've brought along. And viewers and readers, you're about to see a lot of circles in a minute, but I know you wanted to bring along this particular chart deliberately for a couple of reasons. Can you walk us through what the audience is going to be looking at now? Yeah,
sure. So take you through this chart. It's obviously got a lot of detail in it. If we have a look at the left-hand side, I've got the current dividend yield. That's the left-hand axis. And along the bottom there, we've got the growth in dividends per share for the next financial year. So what each of the circles represent is one of the industry sectors in the Australian share market. Now, the first point I want to make is if you have a look at the circles with a high dividend yield, those earnings are going backwards. And the basic point is it's very hard to get high income and growth as well. If we have a look at those growing sectors across the bottom, those sectors have quite a low dividend yield. So the first point is hard to get income and growth from the Australian market. Now, if we have a look at those circles, they're different sizes. And the point I want to make here, the size of the circles represents the proportion of the dividends paid by each of those sectors. And if you look at those three big sectors, that's the resource companies, the energy companies and the banks, they make a huge proportion of the Australian market. In fact, the biggest 6 dividend-paying companies pay 50% of the dividends. Now, all those sectors can be quite volatile, and in a poor macroeconomic environment, the dividends can fall substantially. So this does pose a risk for dividend investors who want to make sure people are aware of. Third point in this chart comes from the little green circle, which is in the top right-hand corner. And that represents an active dividend income fund. And those sorts of funds can get high levels of income, more dividends than the broader market, but still have enough left to provide growth in line or maybe more than the market as well. You can actually get a better result from a portfolio of shares than you can get with any individual share. So that was the third point I wanted to make from that graph.
3 points out of the one chart. Good stuff, Michael. Thank you very much. Shane, where do you fall on this, signal or noise?
Look, like Michael, I tend to think it's signal. There are some specific reasons as to why those dividends have come down. Some of the resources stocks were earning extraordinary profits, and so they've cut their dividends a little bit. I do worry a little bit that with a low dividend yield, it does provide a bit of a valuation signal though, and warns us that the market is a little bit vulnerable from a valuation perspective. I think less so than other markets around the world. The US, you'd have to say if Australia's a little bit vulnerable, then global markets are more so. But the key is, I think as Michael indicated, if we can get the economy having a soft landing, and there's still jury out on that one, then I wouldn't be too worried about it. My inclination is to think that if we do go into recession, it would be a mild one. Base case is we probably just avoid it, and as we go into next year, interest rates will come down, the economy will perk up, profit growth will pick up again, and dividends will yet again come through to the rescue. So I wouldn't be loath to label it noise. I think there is some signal in there, but it just means you've got to be a little bit cautious until we get that growth coming through.
Yeah, no, absolutely. Thank you, Shane. Amy, where do you fall on the signal or noise?
So I agree with the other two panelists that it is a signal, but I'm going to have to disagree on the direction.
Okay.
And I think, it's consistent with thinking about long-term returns. And here I'm thinking about annualized returns over a 10-year period. When you look at bonds, when you look at equities, long-term returns follow where that asset class's yields go. And intuitively, maybe you can explain it by saying, well, when those asset class yields are high, it becomes an attractive asset class for investors, especially income-seeking investors, to get into. And then the more that we pile into it, the more we drive up the prices, and therefore the lower we drive down the yields. So that probably explains that long-term relationship. And so the signal for me isn't so much that we're below the long-term average dividend yield. It's more that the trend in dividend yields, and more importantly, the trend of equity yield advantages over bonds having narrowed to nearly zero over the last 3 years or so. And that spells a period of not necessarily trouble for equities, but that, there's just probably lower hanging fruit elsewhere.
Yeah, no, absolutely. Let's move on to our second topic, and look, we'll talk about fixed income, and we'll start with the 2s10s curve here in Australia. It's well above zero, and it has grinded its way to that point. A positive 2s10s curve, like the one you are seeing on your screen now, infers that government bond traders are not predicting a recession or a soft landing, as Shane and other economists might say, and you can see that there in plain sight. Meanwhile, we've got credit spreads, of course that's corporate bonds, and they are tight by historical standards. We're seeing some BBB bonds in Australia getting somewhere to between 5.5% and 6% in some cases. But nevertheless, investors are bullish on the prospects for corporate earnings and are willing to buy despite the valuation it's demanding and the economic headwinds which still exist. So, Amy, I'm going to come to you on this one as our resident fixed income person on the team today. Does the pricing suggest there are still signals for fixed income to outperform, or is the smart money too polluted by noise? Signal or noise?
There is just so much noise here.
Go on.
The 2s10s curve, I'll start with that one, right? Economists and traders love to say about what a great predictor the curve is for recessions. And it is true that 100% of historical recessions have been preceded by an inverted yield curve. But the time from when a yield curve inverts to when the recession happens is so variable that it almost becomes a useless predictor. So just because the 2s10s curve is steep now, or positively sloped now, doesn't really mean that a recession or a lack of a recession is going to come about in the next 12 months, in my opinion. What you said about BBB bond yields, the yields are attractive only because risk-free yields have risen so much in the last couple of years. Spreads are actually at their cycle lows, pretty close to their cycle lows. So these pricing points, I feel like they're very noisy for telling us where fixed income is going to go next. If anything, the tightness of credit spreads tells me that credit spreads are vulnerable to any left tail shocks that might come along, or even just a regular soft landing, quite frankly. And the steepness of the yield curve in Australia tells you that, if you are worried about some kind of a soft landing or recession in Australia, then going for the long end of the curve is probably a better bet than going for the short end of the curve.
Okay, perfect. Well, Amy, this is probably a good time to take a look at your chart. At the beginning of the show, we talked about how term deposits can net you 5% a year in some cases, but the chart you brought along I thought was really good. It tries to present a case for what you might be missing if you lock your money up in a term deposit. Walk us through this chart if you would.
Absolutely. So this chart was made because so many of the client conversations I'm having right now is about term deposits give you so much. I get peace of mind. I can sleep at night when I lock in these kinds of returns. Why should I go for anything else, especially given the terrible performance of fixed income in 2022? And so with that conversation in mind, I like to show people this chart just to remind them when they lock in that peace of mind return, they're locking out so much more opportunity. And so the conversation right now within markets is largely around, are there going to be cuts coming? How many cuts will there be? When are they going to start? Very little of the conversation is about how many hikes are there going to be. Are we going to need another 2022 style of rapid hikes, right? So this chart is just taking a very gentle easing cycle. I'm assuming that the RBA takes 5 years to get back to what they consider neutral policy rates, which, to be honest, is quite unrealistic and far too gentle. But in this scenario, I'm purely focusing on income returns. And here on this chart, you can see 3 bars for every year. 1 bar is your term deposit income returns, which starts off high, but as the RBA starts cutting, those returns will fall as well, assuming that you roll every 12 months. Then there's the floating rate corporate bond return. Right now, really high in income. Again, as the RBA starts cutting, those income returns will fall as well. And then lastly, a fixed rate corporate bond return, where you lock in the rate that you're able to get today for the next 5 years, just on income returns alone. Now, what this chart shows you is that both corporate bonds, floating and fixed, are a better income alternative right now, today, than term deposits can give you. And so the true question is, when do you make that flip? When do you decide to turn your floating rate corporate bond portfolio into a fixed rate corporate bond portfolio? And I would argue, well, you can leave it to your friendly income manager.
Nicely said at the end. Thank you, Amy. Michael, I'll turn to you with the different data points I was telling you about earlier. What do you think? Do you get any signal from that, or is it noise?
Well, I was really focusing on the 12-month term deposit rate, and I think that is largely noise. It tells you a little bit about the current inflation rate, that there's lots of inflation there, but it doesn't tell you where the interest rates are going to be in 12 months' time. And that's my basic sort of problem with term deposits from income investors. They only lock in income for 12 months, and at the end of it you don't really have much idea what you're going to get afterwards. The one thing you do know is that the capital's going to be eaten away by inflation when you reinvest. So it does tell you something about the next 12 months, but yeah, I see it not a strong signal for the longer term.
Yeah, absolutely. Thank you, sir. Shane, what way do you fall on this, signal or noise?
Mostly noise.
Right.
As Amy said, there is a lot of noise in there. If you just run through them, the 210s curve, it's been useful in the US at times, but I agree, long lag, as we're seeing right now. In Australia, I think it's been mostly useless. I think it maybe worked back in the late 80s, but it's given lots of signals over the years since, and put aside the pandemic, which I think is an extraneous event, it hasn't given a good signal. So it's signalling nothing to worry about, but on the other hand, it hasn't given good guide to recession in the past anyway. So I call that noise. Corporate credit spreads, again, I'd have to agree with Amy. It's telling us the market is relatively relaxed, so maybe you could argue a bit of signal in there, but I wouldn't push that too far. And the term deposits, I mean, Michael is precisely right. We all know that the Reserve Bank has raised interest rates, so term deposit rates have gone up on the back of that. It's not giving us any guidance as to what's going to happen going forward. It just tells you the here and now. It's much like listening to RBA commentary, which we all do, particularly economists get obsessed with that stuff. It tells you what they're thinking at that point in time. It does give you very little guidance as to what they will do longer term. If the facts change, they will as well. And it's the same with the term deposit rate. You can get that now, but that's it.
Mind you, if I had $1 for every time I've heard long and variable lags from various economists over the last 4 years, I'd probably be very wealthy. Okay, so if those particular indicators are noise to the panel, I thought we might make this then the third topic. So I think we'll switch things up a little bit, and maybe Shane, I'll start this round with you. After all, this is Livewire's show dedicated to the intersection of macro and investing. So I'm curious if you could tell us one economic data point that you think should serve as a signal to income investors, and one economic data point that should be considered noise to an income investor.
That's a good question. In terms of signal, to me it's probably consumer spending. The longer consumer spending remains weak, the greater the likelihood that the RBA will cut interest rates, and I think they're getting closer to that point rather than considering hiking.
And by consumer spending, you mean retail sales specifically?
Well, retail sales is probably the best one. I'm just conscious the RBA is soon going to cancel that and move to something called household spending.
I see, yep.
Overall, you've got to try and focus on the trend there and the broader measure. But put it this way, in the short term, it is retail sales. Those numbers have been very weak. If they stay this week, particularly with the income tax cuts coming up, then I think that will provide a strong signal that rate cuts are on the way. There's obviously a whole bunch of other things the RBA would look at, but I think that is the prime one. Just bear in mind, consumer spending in Australia is about 60% of our economy. What to ignore? There's so much noise out there. My favourite saying these days is turn down the noise, because you have to. There is a lot of a racket going on out there. The biggest one, I reckon, is inflation. Inflation is and always has been a lagging indicator of where the economy's been. It's like trying to drive the car looking through the rear view mirror. Unfortunately, I think many central banks do rely on that rear view mirror quite heavily, but it can give you the wrong signal. And I think ultimately, it probably is not going to be the thing that tells us when they start cutting interest rates. You've got to look at more forward-looking indicators, and the most obvious one in terms of where the RBA will go is consumer spending.
Okay, so if I pick up on that point then, this combination of the weaker consumer, stubborn inflation, yes, it's a lagging indicator, but nonetheless everybody watches it with a hawk eye. And then we have, the first quarter GDP print, which came out today, 0.1% quarter on quarter, depending which measure you like to use. We're in a per capita recession. So what does the combination of all those things, I guess, mean for income investors who are, desperate to find yield? And equally, is it understandable that so many investors are still so cash heavy and so risk averse?
Yeah, the latter surprises me a little bit. Internationally, you look at surveys, particularly in the US, there's more confidence regarding investors, and some measures of investor sentiment are not at extremes, but sort of, maybe one standard deviation above normal, which tells you that there's a reasonable degree of optimism out there. Whereas when you look at Australia, consumers are still very cautious. You ask Australians what are the wisest place for saving. The Westpac Melbourne Institute survey does this every quarter, and they regularly say pay down debt or bank deposits. And they were saying that when bank deposits were 0.5%, now they're saying that when bank deposits 4.5% or 5%. So that is probably just messy. But I think the reality here is we've got an economy which is ground to a halt. If you assume normal population growth in Australia of, say, 1.5% rather than 2.5%, the economy would be growing at zero or in recession. But we've been rescued by extraordinary population growth. History tells us that recessions or severe slowdowns lead to lower inflation and ultimately lower interest rates. And I think that's the key message from today's numbers. Of course, you could sort of focus on inflation still being high, but I think that's a backward-looking indicator. The key is the economy is very weak. That will mean a weaker labour market, and it will mean eventually lower inflation.
All right, thank you very much, Shane. Amy, we're going to come to you now. We're curious for your one economic data point that should serve as a signal to income investors, and the one data point that should be considered a noise to income investors.
Look, here I'm going to refer back to the chart that I provided. The bit that I left you with at the end is when do you decide when to switch your portfolio from floating to fixed, right? Yeah. And I think for me, this is not a widely available data point, but if you can get a firm grasp, a really reliable grasp of where peak hawkishness is hit by our major central banks, so this is the RBA, this is the Fed, then when you look at those sort of reliable hawkishness indicators, peak hawkishness aligns with peak yields, right? So if you can be sure that peak hawkishness is behind us, and I currently am, then it means that you can be pretty sure that peak yields are behind you. So if you don't mind a bit of volatility along the way, this is probably the time to start switching from a floating to a fixed portfolio. Now, plenty of noise out there, plenty of things to disregard. My favorite one that I like to point out is a US data point that grabs everyone's attention on the first Friday of every month. It's called non-farm payrolls. It's an insight. It's an insight into what the market thinks is an insight into how the US labour market is doing. And because wage pressures have been behind the sticky inflation business that we've been talking about for many months now, people really like to focus on this one data point. But the seasonal revisions to this one data point are huge from month to month. So even the data point that is released may not be real a month later. We've done tests to see, whether it has any lasting impact or even short-term impact on the direction that bond yields go in. And there's absolutely no relationship. This is noise. Stop focusing on it, guys.
Okay, so with that in mind then.
But what if you're feeling bored on a Saturday morning in Australia and you want some entertainment?
Find a new hobby.
Find a new hobby. Actually, yeah, if you are looking at that on Saturday morning, it might be time to find a new hobby. It's a good point.
Well, you wouldn't want to do it at 10:30 when it comes out at present,
No,
because then you may not sleep.
Then you really will need a new hobby, I guess.
You do.
Yeah. So, Amy, passing that all together then, where do you find your smartest opportunities are coming from in your particular area?
I think Shane summed it up really well, right, with your outlook for Australia. The signs that yields will be coming down, interest rates will be coming down, they're written on the wall. It's just a matter of when. So at this point, I like to be extending duration a little bit in my portfolios. I love investment grade credit, because with investment grade credit, the credit spread doesn't move very much, and even if it widens, the yield that you're getting on a fixed rate corporate bond, when that yield falls, that bond will still perform. It'll still be a defensive part of your portfolio. So right now for my portfolios, I think focus on defensive income, think about duration, think about high credit quality.
Michael, coming to you now. One economic data point that you think should serve as a signal to income investors, and one that should be considered noise. Apparently there's a lot of noise going around.
I'm going to pick the same two as Shane in
Okay.
terms of GDP partial indicators and also inflation, but I'm going to go the other way. So I think Shane's completely wrong.
So inflation is your signal.
So inflation is my signal, and I think GDP indicators are noise. The reason I think that is, while we are really focused on a potential recession, and that is the big fear, we've got the central bank's response. So if GDP and the indicators continue to be soft and get weaker, we get rate cuts, and we get back to a position where I think GDP is ticking back up again. If for some reason GDP surprises on the upside, and we can look both locally and say in the US as well, where it may be even more likely, then interest rates can stay higher for longer or even increase, and GDP growth ends up back where it is. So while in the short term we might see some changes in GDP, up or down, I think it's really noise, because central banks' responses will bring it back to the current level, which I think is acceptable.
So if you are still stuck in cash, where are you finding some of your smartest income opportunities then in the Australian equity market specifically?
Yeah, look, I've got a few ideas for you. As I said, it's actually quite hard to get both income and growth. So I'll actually start off with one which is income only. So Helia is a mortgage insurer, pays close to a 10% grossed up yield when you include the franking credits. No real growth. Doesn't actually make any losses, and so banks are self-insuring, so it's not actually growing, but it's about 1 times price to book, so it doesn't really matter if it doesn't grow, and it's paying a pretty stable, reliable 10% yield. I've got another one which has a decent income, slightly below market, so it's about a 4% yield but unfranked, because the earnings are mainly offshore, and that's Worley. So it's a benefit of the energy transition, so a huge pipeline of growth. We've got close to 10% growth for 4 to 5 years coming forward. So slightly below market income when you include the franking credits, but a really good pipeline of growth going through. There is one sector at the moment which I think can offer income and growth, and that's the insurance sector. Our preferred name within that sector is Suncorp. You've all seen how much your insurance has gone up last time your car insurance came through, and that will probably continue for a couple of years longer. So it's got an above market, fully franked yield, and a couple more years of earnings growth to come.
Shane, I thought it would be nice if we actually closed out the show with a chart that you've brought along. I haven't forgotten it, but I thought it's just a nice way to summarise actually what we've been talking about all along, and it does provide colour and context to the numbers I presented at the start of the show. Round us out. Take us home, please, with this chart.
What that chart basically shows is a bunch of assets that you might consider for yield, obviously from term deposits to a relatively new asset class on the other end called private debt. If you go back, say, 5 years ago, 2019, which is the right-hand side of those bars, you know, you can see the term deposit rate was ultra low, and that was the time when we referred to TINA, there is no alternative. Now, if you look at that chart, you can see that all of those assets, the blue bars, are all offering attractive yields, income yields. And so that's where that common client or investor question comes in, where they say, well, I'm getting 5.5% out of my term deposit, why bother taking on any risk? I tend to think that's a mistake though. Yes, there are alternatives out there, all well and good. If you don't want to take any risk, yes, term deposits might be for you. But I'm also conscious of a well-known quote that, and the person who made this quote has escaped my mind, that no one got rich on term deposits. That is not the way to wealth. You have to go out a little bit along the risk curve If you do want to grow your wealth, if you're just in a stage where you don't want to grow it, fair enough, you'll get some income there. But I think if you look at those other assets, there are lots of opportunities out there. Unlisted commercial property strikes me as one that might be worth looking at. Still be wary on office property, still some capital value downside there, but that's one where there are opportunities. Private debt's certainly worth having a look at. Be cautious on that one though, because it is a relatively new asset class, and so there could be unknown volatilities in there. But I'd have to come back to corporate debt. I'd probably err towards the high end of investment grade at this point in the cycle, given the risks around growth. But that does look quite attractive to me. But that chart I think just highlights there are alternatives out there, but don't get too hung up on bank term deposits, because you will end up missing out on broader opportunities that will come from those other high yielding asset classes.
No one may have gotten rich being in term deposits, but we hope you're all feeling a little bit richer after seeing or listening to this show. That's the Signal Illinois Income Investing Special for 2024. A big thank you to Michael Price at Ausbil, to Amy Patrick at Pendle, and of course to Dr. Shane Oliver from AMP. Thank you all for being here. I thought that was a very enlightening discussion. I hope you all enjoyed being on the show. If you have enjoyed our show, please subscribe to the Livewire Market Index websites as well as our YouTube channel. We're off now for a few weeks, but we will be back just in time for the August reporting season, and we look forward to your company then.